is agriculture finance, and that's what made me bring in the MD into our project at the Tana Delta irrigation project. You need a facility to make sure that with your whole crop production cycle, you're able to fund that rice, make sure that it matures, and at the end of the day, sell it and be able to pay back your financiers. Without Equity Bank coming onto the ground and seeing the actual farming, it would be very difficult for them to understand what we're talking about.
We look to put all our resources in terms of technical assistance to see how best do we support the organization. We are looking to see how do we blend finance so that as management looks to scale, it's not just an ordinary financing arrangement where it's a transactional one, but it's a partnership. As a bank, we are in it for the long term. We are not here just for today. It's a project that we would want to ensure it's for the longer term because it benefits the country as a whole. And that's our pride as an institution.
Agri All Africa's journey in Kenya showcases resilience, innovation, and the strength of partnerships, bringing its vision for agricultural transformation and food security closer to reality. Lubumbashi, known as the mining capital of the Democratic Republic of Congo, is not just a hub for mineral extraction, but also a growing center for business and investment. Located in the southeast, Lubumbashi offers strategic accessibility, ease of business, and growth potential beyond mining. Mining Engineering Services, MES, a subsidiary of Vinmart Group, founded in 1997, is a renowned global commodity trading conglomerate dealing with key aspects of mining, including metal trading, minerals processing, electrical, solar, and alternative energy products. MES under Vinmart Group has transformed global commodity trading with their success stemming from meticulous partnerships and a robust, scalable distribution network. The company deals with a large volume of chemicals, including industrial chemicals, water treatment chemicals, and food additive chemicals. It identifies opportunities to bridge the chemical supply-demand gap and invests in logistics to benefit both suppliers and customers. 70 kilometers from Lubumbashi, lying on 25,000 hectares of maize farm, is Farm Agro Pastoral Jambo, situated in Malambwe Town, Kasenga District. Farm Jambo began commercial farming in 2017 and currently cultivates around 4,000 hectares of rain-fed maize and soybeans.
I come here to DRC to learn more about what Equity Bank is doing here to help develop DRC.
Town,
opportunities are vast. There's so much that can be done here. Of course, capital is needed, and I think this is what Equity Bank can bring to DRC to unlock some of these huge opportunities. I think that this is a good example. You see, farming and food is a big necessity here. DRC imports almost everything. Now we understood that 20% is only produced locally, and Equity Bank has a big important role to play here to unlock these opportunities, to provide capital for all these entrepreneurs who are trying to develop DRC.
The farm has 3 storage warehouses, a maintenance facility, and 4 5,000-ton silos on site.
I encourage everyone to come here, not only shareholders but other entrepreneurs and traders, and I think these trade missions that Equity Bank is setting up. It's a great opportunity to collaborate among all these East African countries, to bring Kenyan expertise to DRC, to see for yourself what can be accomplished here.
The maize produced is transported by trucks to the company's mill located in the industrial zone of Lubumbashi to be processed into maize flour with bran and jam as byproducts. The maize flour produced is distributed directly to large corporates, industrial buyers, and through a network of wholesalers and retailers, including Jumbo Mart supermarkets. With its accessibility, business-friendly environment, and diverse economic opportunities, Lubumbashi attracts entrepreneurs and investors from East Africa and beyond to explore its potential for growth and prosperity.
Nimevutiwa sana na fursa ambazo zipo katika eneo ambalo mimi nalifanyia kazi la mawasiliano, na wote ambao nimeongea nao wanani encourage na wananihimiza hata kuanzia next week nipate kurudi hapa ili niweze kuendeleza nao a number of meetings tulizozianzisha pamoja na kuweza kuona nini tunachoweza kukifanya pamoja.
Equity has given me a chance to meet processors. Equity have given me a chance to meet with miners. Equity have given me a chance to meet with logistics people. And all that can be done by a group of people. I have come to realize that one man cannot do it all. We have to come together, join in different lines of duty, and put a package so that you can be somebody and you can grow.
For me, being here with Equity Bank and getting to see the opportunities presented in the Democratic Republic of Congo was absolutely eye-opening. Our business depends on the growth of our business, at least for the next 30 years, will be driven by the global energy transition, the move from fossil fuels to electricity.
We were invited along on this trip so that Equity could show us the investment case for the DRC, which is obviously quite a material part of their business at the moment. From our perspective, I think it was quite a useful trip, very well organized, particularly with regards to understanding the Congolese investment case for Equity Bank in particular, for the banking industry, and as well as to dispel some of the misconceptions around the DRC which are often seen in news headlines.
Sometimes the perception about DRC is always one that edges on the negative side, but this has completely changed my opinion, my perception of the country. And what I like in particular with Equity is they've invested time to bring together so many different stakeholders. I've not experienced a bank that actually tries to broker conversations between different parties, to bring people to the table, to have honest conversations, and to look for a way forward.
Equity Group Foundation has selected 750 top 2024 Kenya Certificate of Secondary School graduates for its Equity Leaders program. The cohort includes Wings to Fly and Elimu scholars, sub-county and national top scorers who will complete a 6-month paid internship at Equity Bank before starting university. At the commissioning ceremony, Equity Group Foundation Executive Chairman Dr. James Mwangi praised the scholars for their academic excellence and urged them to embrace the program as an opportunity to build leadership skills.
I want to thank you most sincerely, the 750 of you, for accepting our invitation to join this program of developing transformational leaders. And that is why it is called ELP. And it's about nurturing talent, it's about developing leaders. But we thought it is easier to develop leaders from people who have already demonstrated leadership.
Dr. Mwangi reminded the interns that the program's aim is to build leadership skills, empower the scholars as change makers, and equip them for success in university and beyond.
I was very, very humbled to see our young Equity Wings to Fly and Erimu scholars had made or had taken half of all the position in this room, 350. We just gave you a small supporting hand, and you made the best out of it. And here you are, transitioned from Wings to Fly, Erimu scholar, to an Equity Leadership scholar. You make us very proud. You affirm what we have always believed. The future is not a continuation of the past. We can determine our destiny, and it's really glad to see you. Welcome to the new program.
The 750 interns will get a monthly stipend during the 6-month program, with part saved and released when they start university.
We are developing your personality, your character, and your behavioral traits. What are we targeting? We are targeting making you a leader. You have all the ingredients of a leader, but you haven't been given a chance to provide leadership. Every interaction with a customer, you assume the position of the leader. You are the banker and they are the customer. The professional in the relationship takes leadership.
I do believe mentorship is something that Equity has incorporated to the fullest. Seeing people who have taken part, there's someone who has a dream like you, there's someone who has done it. So they equip us with knowing how did they do it, what did it take, and if they didn't, what did they even do wrong.
Having mentors, especially going into a program that's really rigorous, morning hours, working on Saturday, I feel like having someone who has gone before you and done the same thing is really important, so that we don't lose ourselves in doing this. We actually bring the best of ourselves instead of getting lost into the rhythm of life.
The grade I got, the opportunity I've gotten, the ability to actually even study abroad. Once I get the skill and knowledge, my mindset is focused on bringing the people along in this journey. Together we can move as innovators, you see, as creators, inventors, to create modern solutions to modern problems that we are facing.
Since its inception, ELP has supported 29,515 scholars locally and globally. With 750 new interns, 9,700 scholars have now benefited from the program's 6-month pre-university internship, gaining mentorship, leadership, and workplace skills. Propaco has advanced Equity Group Foundation a €1 million grant to enhance climate resilience among smallholder farmers. The grant, equivalent to 140 million Kenya shillings, is for implementation of its high-impact project, Climate Resilient Agri-Food Systems, CRAFS.
What we've seen about the Equity Plan for Recovery in Africa is a very telling one. Our relationship with Equity is a journey of partnership. And I believe, and we believe in France, in a world that is becoming more unpredictable, sometimes more brutal. It is essential that we rely on partners, and sometimes those partners can become friends. And the world of today needs those friendship and those partnership, and we feel we have developed and we're nurturing as we speak this partnership between France, Equity Group, and more globally between France and Kenya, our respective private sector, and between Europe and Africa.
During the agreement signed at Equity Center in Nairobi, Equity Group Foundation Executive Chairman Dr. James Mwangi said the partnership is another milestone in a journey of people.
Low-income people, including small-scale farmers, have dreams and aspirations. But these dreams and aspirations are being frustrated by phenomena like climate change. This is a facility to help farmers to learn new skills, new methods that helps them to adapt and mitigate the adverse effect of climate change.
The Crafts project will provide training, financial access and knowledge exchange to support small-scale producers.
Why the French government, through Popaco, has decided to support smallholder farmers in Kenya? The answer is simple. It is not aid. It is an investment. It is a very long-term investment because the Crafts project is about training farmers for the present and for the future. They will be trained in efficient farming practices such as crop rotation, organic pest control. They will be introduced to new technologies that reduce carbon emissions and save costs.
The project, targeting 15,000 farmers annually, will include knowledge exchange around productive use of energy and sustainable production practices. "750 top secondary school graduates nationwide have joined the prestigious Equity Leaders Program. As part of the program, these students will complete a 6-month paid internship at Equity Bank Kenya branches nationwide, preparing for university. At a 2-week induction at the Sports View Hotel in Nairobi, Equity Bank Kenya Managing Director Moses Nyabanda stressed to the interns the importance of trust, honesty and integrity.
As Equity Group, what we decided to do was to ensure that we truly focus on capacitating and getting the young minds to join a leadership program. Why leadership? Remember, leadership doesn't start when you are like Moses Nyabanda, when you are the MD of Equity Bank. It starts at the level you guys are. I know a number of you have been prefects, have been school captains, but the true defining moment is from now henceforth, and it will continue for the rest of your life.
The MD encouraged the interns to represent equity, engage with peers, and uphold the bank's values of performance, service, and discipline.
This program sets you up. Very few can get an opportunity to do this. But I can tell you, once you go through this 6-9-month program, when you go to whatever university you are, you should be ahead.
The 2024 Customer Service Week Staff Networking event at Equity Center called on staff to return to the basics, reconnect with customers, strengthen relationships, and deliver an exceptional customer experience. Equity Group Managing Director and CEO Dr.
Equity Bank and the International Finance Corporation, IFC, have launched a $20 million facility for refugees and host communities. The risk-sharing facility, launched in Kakuma, Turkana County, is meant to boost financial inclusion for Turkana County is meant to boost financial inclusion for
kitu 2009. Mimi mwenyewe ninapenda ng'ombe. Kulikuwa na ng'ombe nyumbani kiasi walipenda kujihusisha na kazi za ng'ombe sana. Around 2002, 2003,
Turkana County is meant to boost financial inclusion for
pia ninachunga na kazi ya 2009. Hapo ndio nikagundua unaweza fanya kazi nzuri hapa. Nikajifunza maneno ya kutengeneza silage, nikajifunza sasa hii maneno ya kufanya real upgrading.
Turkana County is meant to Equity Bank and the International Finance Corporation, IFC, have launched a $20 million facility for refugees and host communities. The risk-sharing facility, launched in Kakuma, Turkana County, is meant to boost financial inclusion for underserved areas in 14 counties across Kenya. The fund is the first global risk-sharing facility dedicated to financial inclusion for refugees and their host communities.
It's worth noting that this initiative is the first risk-sharing facility globally to be
to boost financial inclusion for underserved areas in 14 counties across Kenya. The fund is the first global risk-sharing facility dedicated to financial inclusion for refugees and their host communities.
It's worth noting that this initiative is the first risk-sharing facility globally to be
to boost financial inclusion for underserved areas in 14 counties across Kenya. The fund is the first global risk-sharing facility dedicated to financial inclusion for refugees and their host communities.
It's worth noting that this initiative is the first risk-sharing facility globally to be
to boost financial inclusion for underserved areas in 14 counties across Kenya. The fund is the first global risk-sharing facility dedicated to financial inclusion for refugees and the company that bottles 80
capacity, so they are forced to have generator solutions and then also invest very heavily in UPS systems so that they keep running, because the Schnell power distribution is a bit fluctuating or not reliable. So it is something we are looking at if we could partner, so we can give them so they are forced to a very good power supply for their production.
This roadshow had a lot of international investors who I think had never even come to the DRC before, probably not having seen much of Africa at all. But I think they were really attracted by having a trusted partner like Equity Bank on the ground that's really able to show them kind of the ropes, introduce them to trusted parties so they can really do business on the ground here. The roadshow really helped put things into a real-world setting. We got to meet lots of companies that are unlocking this massive market, doing very exciting things, digitizing their supply chain process, doing incredible things on the social impact side, and it's great to meet these companies in person, and I'm super excited to invest in the ecosystem.
The 2024 DRC Investors Roadshow started in Nairobi, Kenya, and took a plane load of participants to Kinshasa, terminating in Lubumbashi in the south of DRC. Equity Bank Kenya has partnered with Agri All Africa of South Africa in an initiative aimed at improving food security through large-scale rice cultivation in Tana River.
It's almost like Pishori, Pishori is setting itself.
So it's aromatic?
It's aromatic. Yeah. And by the way, it becomes even more aromatic when we grow it in this environment. Yes.
The collaboration is supporting efforts to reduce Kenya's rice deficit and strengthen local agricultural value chains. Inaugurated by President William Ruto and Agri All Africa Director and Boholo Group co-founder Priscilla Dimakatso, the initiative earned praise from Equity Bank Kenya Managing Director Moses Nyabanda, who highlighted the need for strong partnerships to boost agricultural productivity during a visit to the Gamba farm in Tana River County.
Today, Agri All Africa has shown us what's truly possible by what they've invested in. They're looking to solve the food problem, particularly for Kenya, through one of the main food crops for Kenya, which is rice. They've invested 500 acres. As Equity, we are looking to partner with them to the long term to see how best can we scale that up so that Kenya becomes food sufficient.
During the visit, Priscilla, an experienced entrepreneur and global business leader, emphasized the strategic approach behind the project's implementation.
When we started this project, it was very clear that this was a brownfield, not a greenfield. And the key thing was to partner with the government of Kenya and do a PPP for at least 20,000 hectares. And we have to come in and make sure that we need to put in the infrastructure, we need to make sure that we develop the land and put in our inputs. So we decided to go into a strategy of leasing the land from government, and we have leased 4,000 acres from them for now.
Despite early setbacks, including the devastating 2023 El Nino, the project has demonstrated resilience.
We first started this project and we were hit by the El Nino. Very good lessons, because after the El Nino, over 370 acres of the land survived. So we had to do a lot of studies on our rice and what made that particular rice crop survive. We then had our ratoon crop, and with the ratoon crop we were able to recover from the losses of the El Nino. We negotiated with government again and we came back, and here we are now on our second crop with a solid lease.
Currently, 1,300
project that Agri All Africa has taken is important for us as it solves a big problem around food needs for Africa. As we come in, we are looking at how then do we work with the proprietors and management of Agri All Africa in ensuring that that comes to fruition.
The project spans the entire rice.
Good morning, everyone. Morning. Good to see all of us here, and we want to thank God for today. We want to kick off our full year 2024 financial results announcement. But allow me to kindly invite Reverend Evans to kick us off with a word of prayer. Reverend Evans, karibu.
Thank you very much. Good morning. Good morning. God is good, and all the time. Shall we pray? Our Heavenly Father, in the name of Jesus, we want to thank you so much for the gift of life and health. Thank you for this day that you have made, that we may come, Lord, and receive our results for the year 2024. We want to thank you, Lord, for the successes. We thank you, Lord, for every opportunity you gave us. Thank you even for what we missed. And as we come, Lord, we want to pray for your blessings. We pray for your covering. We want to commit this meeting before your holy presence. We thank you for all of us who are here and even those that are following us. Lord, you shall join us together in one spirit. We pray for renewed strength. The Lord, at the end of it all, may your name be glorified. Start with us, go with us to the very end. For this we pray through Christ our Lord.
Let's appreciate Reverend Evans. Thank you. I want to kindly request us, before we invite our Group CEO and MD, Dr. James Mwangi, to take us through the results, to be upstanding for the Equity Anthem.
Equity we have, all the staff, customers and partners, coming together, our purpose common, creating wealth and transforming lives. I am a member, you are a member, we are united. sing, moving together, every day we grow. Our hearts so grateful, forward we march. I am a member, you are a member. We are united by equity. Equity are listening, caring partner, transforming people's lives. I am a member, you are a member. We are united by equity. Equity are listening, caring partner, transforming people's lives.
Thank you very much, Alex, and a very warm welcome to the Fourth Estate shareholders and investors attending this morning's investors briefing for the year ended that 1st December 2004. As you might be aware, we have taken a little bit of time to come to the investors and shareholders with this briefing because we really needed to seek to understand the results so that we could help shareholders, investors, analysts, and media and understand the context and the results we're about to present. We know our investors have taken a long-term view. They're investing in an asset. So it's not about numbers, it's understanding their investment. That's the most important thing. So today I've been very selective. I will speak to a few slides that will help investors appreciate their investment, understand their investment, where we are, and the context within which the results are coming out. But you can't understand your position without your understanding where you are coming from. So we have put this into perspective. And then we will end by looking where are we going, so that it's the past, the present, and the future. And we'll look to contextualize so that investors can have a better grip, a better understanding. We all know investors don't invest in the past, they invest into the future. That's what investments are all about. It's the cash flow, it's the returns, it's the growth of the investment. So kindly join me as we go. That is our history. As you can see, a very smooth curve. If you look from 2005, very gentle, but come 2020, we start seeing significant lack of smoothness. It's not as really as smooth as it was and that is customer deposit. So we need to look and pay a little bit of attention from 2023, 2024, a huge stagnation. Is that a stagnation? Maybe not from a customer's point of view. That might the issue of the reporting currency. You'll see Kenya shilling strengthened from 160 to 130, and that significantly is reflected or impacts the reporting number. So we'll guide you what the actual number would be in a constant currency. If you look at the next slide on loans, again, look at the same. What one would wonder, what is happening in the last 2 years, 2023, 2024? We've seen, and again, we have just said, and we will see later, that we have a mix of currencies, a basket of currencies. And if the reporting currency strengthened beyond that will be seen. And one would think there is a decline in loan book, but it's not a decline in loan book, it's because of change in currency vis-a-vis the currencies of the subsidiaries. The reporting currency is Kenya shillings, but more than 50% of the loan book is not in Kenya shillings. So when the Kenya shillings appreciate with that level from 160, then you see. And if you look, that is their own portfolio. If you go to the next slide, you look at total assets, you see the same. So that is reporting needs to be, it's a mathematical currency impact that we thought we could be able to explain. And the next slide, Alex, as you can see, profitability is from 2021, seems to be stagnating. If we go to the next slide, if you look at shareholders' funds, there we seem to be in control. The curve is still as smooth as it has always been because that's something within our control. The rest might... so for the first time, we see equity which has maintained a tenfold growth from 1991 all the way to 2016 or thereabout. Starts not to have uniform. You see total funding remains almost constant. Loan book remains constant. Total assets reflect decline. And that is what we thought we could be able. Profitability stays constant. But again, we asked ourselves, what does this reflect? And we'll see also in our ability to forecast and the impact on forecasting. If we go to the next slide, you see this is the cause of what we are seeing. Kenya, the host of our head office, has been going through very significant shocks since 2016. But look at the shocks we are dealing with in 2025 and 2024 and 2023. We're dealing with the interest capping shock from 2016. It initially parliamentary legal capping, then it became an administrative capping, and it was resolved with a compressed risk-based pricing that the market is not able to understand. It's too complex for the market, and I'm sure. Of course, COVID, the health pandemic ended at the end of 2022, but its impact is still with us. The disruption, the breakdown. So you could see, if you add that, so then add the Russia-Ukraine conflict and its impact on energy and food inflation, the Israel Gaza, Palestine conflict, the global economic shocks, a mix of all those, interest rates, inflation, currency volatility or exchange rate, the escalated geopolitics that has manifested itself now into trade wars. We thought it to stabilize that technology. I'm sure you know the war of technology, who controls technology. Now it has gone beyond technology to trade. Call it trade tariffs or whichever name you call. These are the shocks, and we have not had a perfect storm where you have simultaneously about 6 shocks playing at the same time. And that is what is causing that. It's affecting the bank, and it's not able to smoothen its performance, because if it's one shock, like we have seen, it doesn't mean before 2016 there were no shocks. 2007, 2008, we had local shocks of the conflict, post-election conflict. We had the global financial crisis, but you were dealing with 1 or 2 shocks. The bank has the capability to manage those shocks. But the volatility in the marketplace with this kind of shocks then makes it significantly difficult to predict. And most of these shocks will then work counter each other. And so you're in a very volatile environment. It's what you could, a pilot would say, I'm flying through, yes, George? Exactly, it's headwinds. It's really turbulence. And some economists would say we are navigating the eye of a storm. This is when you then see, and the question here is then differentiated capability in decision making. But it's very difficult when you, for anybody now to manage the external environment. So what do you do as management? You revert inwardly. You have control of the internal environment. If the external environment is difficult, the pilot will always say, then I'll put on not only the outer equipment, but I'll combine that with the human capability to navigate the eye of a storm. And that's how you'll find the pilot tells you, yeah, Kaidre, buckle your belt. We are going through turbulence. So the moment the world is going through a very difficult turbulence, and we have seen what is causing the turbulence. So the issue is the impact we have seen in our performance is because of this turbulence, but turbulence don't last. However, we have recognized, we thought this turbulence weird, but shock is building after shock. So what have we come to conclude is that the VUCA environment is becoming a permanent state. And we must know how to manage business in a volatile environment, in a very, very volatile environment. And essentially, the environment is, a pilot cannot change the weather on the route they are passing through. But they can ensure their plane has the capacity and the resilience. And if you have heard the word repeated, resilience, the African Recovery and Resilience Plan, it's all about how do we work inwardly to ensure Equity Group, your investment, is resilient enough to be able to perform in a turbulent environment. And that then leads us, with the lessons of the last 10 years of significant turbulence, we decided, yeah, we can't remove the threats, but we can remove the weaknesses within the organization that threats exploit and make it difficult for organizations. So what we have been doing is thinking inwardly, removing weaknesses, strengthening our strengths or building heavily on our strengths so that whatever green shoots are in the challenging environment, we can see them, we can be able to extract and exploit them. So broadly, that's where we are. So if we move to the next slide, or 2 slides more, Alex. Yeah. So broadly, what we have said is, why don't we transform Equity Group? We may not transform the environment, but we can transform equity to make it very resilient to operate in a turbulent environment. And broadly, the first thing is look at your strategy. And the strategy of equity has focused on building resilience. And that is why it's the African Recovery and Resilience Plan. The second aspect other than resilience is whatever impact turbulence have had, can we ensure the organization fully recovers? And then we have said, let's not focus on Kenya, let's look at Africa. And that's what pilots do. Pilots change routes. When the normal route has turbulence, they don't fly to an eye of a storm. they take a different route. And I'm sure the last 4 years, you have heard of our strategy of saying banking is affected differently from insurance. Can we change the mix of our business so that if it's banking that is being affected, then insurance will keep on rewarding shareholders? Can we reduce the sovereign risk? Countries are affected differently. Like in our region, Kenya is the most integrated globally. So essentially, it has the biggest transmission effect into business. So we have focused a lot on the strategy of the group, led by Brent, and Brent has now a team of 7 that lead a focus on strategy. Maybe I will ask the team in the strategy office to be upstanding. Yeah. Very good. Oscar, I thought you were in strategy. Very good. I thought, Vicky, you were in strategy. People don't know themselves, it looks like. And also the missing is John and who else? And Charlie Wilson. Where? So that is the team that we have entrusted and said, how do you deal with this? Those who know Oscar joined us from being the chief executive of Nairobi International Financial Services. Before Nairobi Financial Services, he was the counsel to Qatar International Financial Center, and for 9 years. And before that, he was in London Financial Center for 16 years. And I said, how do you deal in turbulent markets? You have seen these for, if you take 16 plus 9 plus 5, oh gosh, you have worked that long. 30 years. 30 years of operating in the markets. The other one is the former chief executive of image registrars, Vicky. You can, I said, Vicky, look at it. Oscar brings international markets experience, Qatar and London. But we have our markets here. Those who may not know, image registrar is the largest governance and registry, helping all the listed companies in the Nairobi Stock Exchange and comply. So we said, work together, so it's global and local. Then we went to economics. This is about economy, understanding economy. We picked Charlie who? Brent? Robertson. Charlie Robertson is the emerging markets most renowned economist. He's the author of the book, The Traveling Economist. And you can Google The Traveling Economist. It will give you his profile. I bet I'm not wrong that he's rated the best economist in emerging markets. When you talk about emerging market, I want to remind you, China is an emerging market. So that's the caliber. But we then matched him with our own, Wele, one of the most renowned advisors to the Kenya government, said, we must predict how the government, so it's truly creating a strong strategic team equal to the task of significant turbulence. Then we got John on capital allocation from Helios, previously Barclays Capital in London, and said, how do capital allocation works? And work very closely. And of course, then we got maybe one of the most renowned commercial lawyers in the market. You can raise your hand, Gertrude, and said, this is legal. Let's do the legal. And David Bagenda, former strategy director of Diageo, finance and strategy director for Diageo for how many years? 5 years. And before, why did we go to Diageo? Before Diageo, he was in BAT, because we needed to understand the consumer mindset. this turbulence, the person it affects is the consumer. There is nobody who understands consumer than FMCG. And that's why we said, why don't you come and be the strategy execution director? So that team is the one we have entrusted. Those who were in the bank 4 years ago when turbulence started can sit. If you were in the bank 4 years ago, only Brent would sit. All the others are new. Gertrude, less than 2 years? Almost 2 years. Vicky, 5 months. Oscar, 7 months. 3 months. Where? 3 months. There's Charlie, 3 months. So it's a new team built for purpose, fit for purpose. So essentially you could see how strategy has been thought and how much we have invested strategy. They are in charge of organizational culture, the business model, and the kind of seat colleagues. The second one is governance. It doesn't matter how much you deal with issues. If you don't have the right governance, things will go wrong. You strengthen, and I'm glad that our chairman, Professor Macharia, is with us. Professor, maybe you could start. We have been humbled. When I did this, the chairman also decided to enhance and strengthen the bench of the board. And maybe today I would say, and we'll talk about them another day, we might have the best board anywhere in the world. Anywhere in the world that has been brought to help us, highly experienced people who could help us cope with this. One of the most celebrated board member is the former chair of Tata Group in India, and previously the vice chair of IFC, the private sector arm of the world, and say, can we understand economies? So the chairman has really strengthened his board to be able to, all boards, I think it's all boards, to have the capacity, the competence to guide such assembly of CEOs in the strategy, to question and to create tension between management and the board so that you don't have. So that governance, and then we have created the position of governance in management. That is what Victoria is focused on, Group Director of Governance, Strategic HR, and what? And Chief of Staff. So because aligning people, so really get everything aligned for people. So when we have seen she's in charge of regulators with Chief, so that has really been done. And of course, the people, then we have asked ourselves, what would make people stick with equity? What would make equity attract the best people on earth? And now that it has attracted them, how will equity keep them? And it's a question of looking after your people. Give them the best medical scheme that the world can provide, the best pension scheme. I want to say we're now up to 20% of salary as a pension, so that in old age you live the same quality of life as when you were working, because you are saving 20%. Medical comprehensive, minimum 2 million shillings cover. We are glad the shareholders allowed us to benefit from 5% of the entire bank group as to create an employee share ownership scheme. You can't attract that kind of people. You can't retain high quality staff without a very good performance reward and compensation scheme. And in the unlikely event there is a challenge, a life cover for staff of up to 8 years gross salary, so that it could take care of families that would be left behind. Bring certainty in in the employees, so that the only thing you can count on during difficult times is people. Get the right people who can make differentiated decisions and are passionate and enthusiastic. It doesn't matter how good people are. If they are not happy, the outcomes are not good. People can only be enthusiastic and passionate because they are happy. Nothing has ever been achieved without passion. So that's really what we have focused on. But the end game is the customer. But we deliver to the customer through systems and processes. And I feel very, very proud with what Equity has achieved. It's unfortunate the entire team of IT, which is being headed by our executive director and chief operating officer, is in India, a team of 24, and it's really ensure we have the best systems on earth. They have done the core systems or infrastructure that is complete. Processing capability has been done, and now they are looking at processes. How do you re-engineer processes so that they deliver to the customer? They have built a product house that has developed the right products here, and I'm sure all of you could witness that instability of our system is something of the past, and we are very excited. And we'll see our transaction, despite the challenge, our transactions this last year went up by 67% because the systems are stable. Customers have come back, they are trading. Those who had become multi-banked has come back, they have refocused on the bank because the systems are capable, they are reliable, and dependable, and are accessible. So broadly, that is what we are focused on. We are focused on this because we are living in uncertain times. We can't make uncertain times certain, but certainly we can prepare ourselves for uncertain times. And everything has been made fit for that purpose of living uncertain times. It's not easy to navigate an organization when you have 6 shocks simultaneously. Alex, bring back that slide of shocks. It's about, this is what we are dealing with, an environment, what you could call a perfect storm. So the only thing we can do is look at how do we have strong capabilities within the organization that differentiates us. How can we make differentiated decisions? Because we need differentiated decisions. That is the quality of management. How can you give management the right tools? That is IT, the systems and processes must be the right. How do you get the staff to be committed to battle in turbulence without losing faith or confidence? By looking after them, investing in them. So this is the time that you really focus on investing on your staff to make sure that they can remain loyal, they can remain committed, they can be enthusiastic, and they become great champions of winning the battle. We are in a battlefield with turbulence, and that's what it is. So having done that, then we asked ourselves, but also, how does the environment has opportunities? So Alex, the next slide. And we look at East Africa. We said, there is turbulence, but you pick what you see. We have chosen, we have built enough resilience, we have built enough capability to ride a turbulence. So we have focused on opportunities. Every crowd has a silver lining. Our silver lining, which holds the future for this bank, is that we are lucky to be in the fastest growing region in Africa. And when we look at that growth, it's not a seasonal growth. It's underpinned by fundamentals that guarantee long-term sustained high growth, whether it's DRC, whether it's Kenya, whether it's Tanzania, whether it's Uganda. They are growing on the strength of fundamentals. And we can predict that, and we believe that East and Central Africa is the new Southeast Asia. And those who know Southeast Asia, the Singapores, the Taiwans, Hong Kongs, they sustained growth for nearly 30 years. We believe that's the beginning of our 30 years of very, very rapid growth because it's really fundamental. And you can see how on average East Africa is doing compared to all other parts of the world. It's almost growing 5 times faster than the euro. It's growing 3 times as fast as the United States of America. So what will that growth do? It will attract global capital and global investment. And we believe that will play on the platforms of equity because the strategy we took of diversifying in the region, we acted on it and became systemic in the entire region. So if we want a regional bank, then there is only one, equity, as we shall see. If we move to the next slide, then we look at monetary policy. We are seeing stable inflation for most of our economies. Yes, there is turbulence out there, but back home, the turbulence is not significant. So we're not dealing with the domestic issues. We are dealing with international issues. So you could manage the cord that links the local with there is only one vertical that you need to really focus on. And when you look at the inflation outlooks, it looks like it will be fairly managed. There is nowhere inflation is out of range. And that gives us really confidence. If we go to the next slide, Alex, we look at the outlook. Kenya, very promising. Tanzania, very promising. Uganda, very promising. Same as Rwanda and DRC. There will be internal challenges. You can talk about the Great Lakes conflict. But that conflict has been there for 30 years. It's only we are hearing it more because it's active. The active volcanoes have been with us every 20 years. They erupt, but life continues after they have settled. So that's the confidence, that's the outlook we have given the fisher. And broadly, when we look at the region, we are happy that Kenya, despite not being the fastest growing economy, still anchor the financial market stability. And that then gives us confidence that our headquarters, our reporting currency, is of the strongest economy in the region, the most stable, because reporting, as we saw, is a big issue. And when you look at upside opportunity, this is the most significant slide. You'll see, if you take these rates as today, the East African region this year is growing at 8.75%, when the world is growing at 2.8, when Europe is growing at 1.7. That's the energy that we talked about. We can talk about GDP to debt to GDP. We believe it's still manageable. The monetary policy rates, the inflation. So this is the summary of the economy. And we are saying the resilience we have built could enable. And lastly is that we see East Africa as the heart of the thriving ecosystem of the African continental free trade area. It's the most integrated regions in trade. And that is the opportunities that we are not strengthening the organization purely for capability. We are strengthening the organization for the opportunity, the East African regions. So what it means is it will not just be a cost. We know we have front-loaded management. When all these chief executives come in 1 year, of course you see a significant jump in cost. But for sure, within 3 years, who have generated enormous volume of business because the opportunity is strong, that the unit cost of staff will be negligible. Alex, so you can move on. So let's go to the strategies then we have been, and let's measure the health of the organization. Our priority strategy has been regional diversification of the banking business. And as you can see, we are very, very excited that when you look at the region, from a past perspective of deposits, 48% of our deposits are outside the region. Loans, 48% of our loans are outside Kenya. Our assets, 49% of our assets are outside Kenya. But look at revenue. We don't do assets for the sake of assets. We don't give loans for the sake of revenue. Look at revenue. The region is outperforming Kenya. 54% of our revenue is from the region. And when you look at profit before provisions, 55% is from the region. Profit before tax, 54%. And we feel very confident that we have de-risked the sovereign risk of head office. And this is when you know you are successful, when the regional subsidiaries become bigger than your parent company. That's really then when you say, wow, the strategy of expansion is really, really working. And we take significant pride as to how that has happened, and that ensures that that diversification helps us to manage the economic shocks, because different countries, as we saw, they have different economic parameters. So you can compensate. And we have seen as Kenya went through huge challenges, DRC jumped in to really support the organization. And we can see, maybe shareholders, you can look at return on average equity. The babies have a better return on equity than the parents. That's when you then realize you are doing better when your children goes to a higher grade than yourself. That's when you say you are successful and you have a legacy. And we are excited that even return on assets, the region has 2.7 when Kenya is at 2.4. And it then demonstrates where work needs to be done. If we look at the next, how do we see it? Because sometimes you can see the numbers and miss the big picture. The big picture is that we are number 2 in Kenya, number 2 in DRC, number 2 in Rwanda. Those are the most significant markets. The 2 largest markets, Kenya and DRC, the central market. And as you can see, Uganda, we're number 5, and not too far from number 3 and 4. And South Sudan, we're number 4, not so far from number 3. So essentially, we can generalize, George, and say we are systemic because we are in the top 4 positions in each of the markets we operate in except one. That's when you then say your strategy works, not in your domestic market, in a foreign market. The business model is working, it's accepted, and you also say the brand is performing across markets. And that is a very good position to be as an organization, and I feel very, very proud of what our management has been able to do. Then we said banking is not enough. Banking behaves differently from insurance. Let's diversify from, yes, we go regional, but we also diversify our offering of products. And we decided to go into insurance. And as you can see, we saw the graph of the banking, and the last 4 years have been significantly difficult. But look at what is happening in insurance. Look at the policies. We now have issued 14 million policies in 3 years. Ajara, that is about how many times the number of policies issued by the other industry, the other players? 2.4 times more policies than the entire industry. And you say, it's the brand. Remember I said it's the brand, it's the equity brand. So it performs well in banking, it performs well. And you can see unique customers, 6 million unique policy holders. What does it mean? Every policy holder is having at least an average of 2 policies, at least 2 policies. And we are very happy that the consumption is, can lead us to cross-selling. So insurance we do. Then we ask ourselves, what is the big picture? And the other slide, look at life industry. In the 3rd year, you are number 4 largest insurance in the industry and credit. And you can see it's neck to neck with, and that position in 3 years, actually we will finish 3 years this quarter. We were still 2 years and 9 months when we printed this count. We are finishing 3 years this quarter. But you can see the position. We are number 1 in return on equity, number 4 in profitability, number 7 in total assets. How many insurance companies are there in the industry, Ajara? 64. So you are not number 1 out of 2. You are number 1 out of 64. So sometimes that's why the context is very important. So we're very, very happy that the brand is performing wherever it is. The reputation of the brand is very, very strong. So we are happy with insurance. So banking is doing well. Insurance holds the promise of the future, and then you look at technology and how we are performing with the technology. Of course, the end of COVID reflected a slight challenge, people going back to the old ways. During COVID, we were doing 89% of all our transactions were digital, but we came down to 89%. But we have started going back. We are now up to, we came to 85. We are now roughly 86%. We'd like to see more digital. We saw our customers going back to agents, but it looks like they are now getting back that maybe online business is a better way. So again, the technology group has really supported us. And the channels, we talked about the product house. Really, it's not just product, but the channels. But look at the performance of the channels. And what really has drilled us is that we have moved from brick and mortar, we have moved from the variable cost channels to self-service channel. What self-service means is that they are no cost to us. It's the customer serving themselves on their own devices. That's no cost. And as you can see, those are the dominant channels. And that's what the previous slide, Alex, if you look at the digital channel, our self-service, agency is third party, and the ATMs and branches is brick and mortar. Now you can see how the shape, so that you can interpret the channels, the dominant channels are now the self-service. We are increasingly becoming an online banking business. What does it mean? We're able to provide banking 24 hours, wherever you are, whatever time. So we have compressed distance, we have compressed geography to allow customers the freedom. When we look at the non-banking, what is the contribution of the non-banking? As we can see, we take confidence that most of the numbers are showing an upward, whether it's profit before provisions. If you look at profit before tax, yes, it's small, but the direction is right. That the insurance, it's not just growing, but it's growing faster in profitability than the banking industry, and that's why its ratio of contribution is growing. We now, this year, have activated the general insurance. This is just life insurance. So general insurance and health insurance now will come and play. So if you assume even at the beginning, each of them takes 3, it means 10% of our business will be in the insurance industry, hopefully by next year. Yet, this is a systemic regional bank in the top 4 positions in 5 markets, in the fastest growing region in the world. I have posted so that we be on the same page with what I've said. That's a very loaded statement for an investor. So within we have seen, and then the last is our 2 engines, the social engine and the sustainability engine. We are very, very excited. One number that you may want to take that speaks very, very significantly is the contribution to women and youth in providing livelihoods, opportunities for them to be in business, 2.5 million customers. The second one you may not want to miss is the last quadrant. Look at Equity Afya. 3.3 million patients in a period of 4 years of startup. And you may also want to see the Equity Afya clinics are now 132 in 4 years. So since the end of the pilot, and we're very, very excited about Dr. Joan. So Dr. Joan can answer all the questions about the social engine, the banking engine, Moses, insurance, Ajara, and Brent will talk about strategy. So you now know who to direct the questions to so that you really can get to the depth of it. So what is the story? The story is we have built resilience, we have built leadership that is differentiated, we have built governance that is really strong, but despite that hard work, how do the numbers look like? So Alex, if we go to the numbers, this is our numbers, the balance sheet. And you can see the growth between 2024 and 2023. As we said, one of the biggest issue was the strengthening of the Kenya shillings from 160 to 130. So it has significant impact on our numbers because every currency is being translated into Kenya shillings. So while on the face of the balance sheet, it shows like we didn't grow, that we are mark timing at 1.8 trillion. If it was like for like, that the currency was constant at 160, we could have grown from 1.8 trillion to 2.1 trillion. That's an 18% growth. The region is growing heavily and significantly, very, very fast, as we said. When it looks, look at deposits, again, like for like, in terms of constant currency, we have grown at 23%. But remember, 40% of our balance sheet is in dollars. So the dollars have been translated at 130 instead of 160. So we could see the impact. You look at, because the health of a bank is intermediation. So you look at both the customers' trust and confidence. At 23%, we're happy. Look at shareholders. Again, very strong capital buffers. the shareholders' wealth is growing faster than the balance sheet, almost 2 times as fast as the balance sheet on constant currency. If you look at the other item that you may want to look at is liquidity. Liquidity is very well, if you look at cash and cash equivalent. As we turn the corner, we're very well positioned to do business. And this is what one of the biggest responsibilities we had was to structure or to restructure the balance sheet from the turbulence. How do you have your balance sheet? Turbulence doesn't last. They say seasons come and go. So we believe they will go, but how well will we be positioned? As you can see, the 2 biggest buffers, or let's extend them to 3. The 3 biggest buffers is capital. How well are you seated with the ultimate protection of a business, capital? How well are you in liquidity, for agility, for quick turnaround when opportunities, for ability to take opportunities? Look at a combination of cash and government securities that are tradable. That's where worth of the bank, so that's liquidity. Kenya has almost a liquidity of 82%. The whole bank has a liquidity of 57%. So it's really, and we're hoping these opportunities will unlock. We're very well capitalized to grow the business. And we shall also see when it comes to net loans, we stepped up provisions to ensure that the quality. I take pride that we might have the best coverage in terms of provisions at 71% coverage, so that you don't carry or be lagged behind because of need for provisions. We have taken whatever provisions we need at cash basis at 71%, ignoring the securities. If you look at P&L, that is of great, we all knew we were struggling with interest income. Interest expense was growing faster than interest income, and of course our net interest income is where we struggled. It's more at the top line. Non-funded income, much better. Total income, 6. And again, as we said, loan loss provisions so as to enhance the quality of our asset, up 43. You don't fail to provide, you tell the shareholders the truth. These are difficult times. We all know NPLs in Kenya are around 16% as an industry. We are glad that we are at 12 when the industry is at 16. But if you look, we start out as the bank that has made the biggest provisions relative to the balance sheet. We've now managed to, despite the huge staff complement we have acquired, we have now stabilized our costs of staff, meaning that most of the staff are just 1 year, so the 2 numbers are now almost equal and stable. So profit before tax, we go up. Maybe I should have emphasized that this resort, when we saw revenue is strained, is growing at 6%, we then said, what do we have control over? We have control over our expenses. And as a result, you can see we constrained our costs, a growth of only 2%. And that gives us a 17% increase of profit before tax and 12% after tax. Very confident about the future. As you can see, we increased dividend from 4 shillings to 4 shillings and 25 cents. The capital is big. We don't need leader. We need to start. These are difficult times. It's not only difficult to organizations, but also to shareholders. So how much do you invest in shareholders? You don't just look after staff, you also look at your shareholders. There are many stakeholders you need to balance relationships on. And the dividend payout becomes a record dividend of 16 billion shillings. And we hope this will not only go to the shareholders, but will be felt at the economy level. And dividend yield per is at 850. So the 4 shillings and 25 cents is of a share of 0.5 shillings. That's the value of an equity share. The par value is not 5 shillings like most of the shares we compare with. Ours is a 50 cents. That's the par value. That's really the money we get from a shareholder as the capital. But you are, for 50 cents, you are giving 4 shillings and 25 cents in a year. I hope shareholders can see how the yield for your plant is. But going forward, what really we focus on is the ratios. How are the ratios? As you can see, the ratios tells us the health of the organization. Analyst, this is your page. PAR, as we can see, we've come down to 12.2. Coverage, we are at 71, higher than last year it was 67. So we are, despite improvement in quality of loan book, we have increased. And of course, loan deposit ratio, the lowest we have seen in many years, below 60. Core capital at 17 and 19. When you look at core capital and total weighted least capital, 14 and 19, 8 and 17, 10 and 17, it shows how capitalized we are, and that's why we are willing to pay out dividend generously to the shareholders. And as we said, look at liquidity at 57. So Alex, if you go 2 slides back, we then are confident, sorry, no, 1 slide forward. So we increase our profit from 43.7 billion to 48.8 billion. That's after tax. But before tax, we increased our profit from 51.9 to 60.7 billion shillings. We're very, very confident. How do we look at the past? Alex, if we can go at the forecast. The first one is to look at what had we given as a guidance. We were very optimistic that we could grow loans at between 2 and 5%. We missed the target. Our loans shrunk instead of growing. We were optimistic we would grow our deposits between 7.5, but to 7, we only grew by 3%. And this is what we are talking about. We are operating in a very turbulent environment. If you look at those numbers, particularly deposits, we might be the best in the industry. Everybody else has shrunk in deposit. It's difficult times, but we've been very, very resilient. As I said, this picture is because of the structure of, and in summary, so that people can understand how our balance sheet was. Interest capping, the shock, made us unable to lend to unsecured borrowers. So what did we do? We bought into government stock at 10, and then the cost went all the way to 18, but your interest on tertiary bills remains at 10. We bought Eurobond at 7 interest rates, cost went to 12. You're getting negative. The good thing, we've seen significant reversal. The central bank rate is where it was before the peak, so that is normalized, and you see a normalized performance when we report the first quarter. And that explains why, despite missing the targets for last year, because of 6 simultaneous shocks, which we couldn't be able to really predict when they could hit. We are now more confident. We have built a resilient team, a resilient balance sheet, so we are optimistic that this year we'll grow our loans by between 10 and 15%, deposit between 10 and 15%, and we will test this in the first quarter, which we will be reporting in just about a month's time. And that also explains the net interest margin. We're optimistic. We will enhance that. Non-funded, we are optimistic that we'll still be able to retain above 40%. And now we are confident that because we have seen stabilization in cost, interest expense is likely to come down significantly. We are confident we'll be able to be below 48. Return on equity, we had projected 25 to 30. We landed at 21.5, and we could tell the reasons. Return on assets. So our optimism and confidence in the future has not been affected by the turbulence. It's reinforced by the strategy, the capacity of our people, and more importantly, at how we have been able to adjust the bank. And the cost-income ratio, we're confident we are even aiming lower than we had aimed last year despite missing. We say that was a storm of the eye of a storm. We are through the storm, or we have built resilience of operating in a volatile environment, and that tells us confidence. We're confident. I think we need to pay a little bit attention. The subsidiaries' contribution, we have targeted the same because we are feeling like Kenya, the sleeping giant, is waking up, and will push back. And it will be interesting to see Kenya regaining to contribute more than 50% of the profit. So we are wishing Moses well. The task is his, but he has taken it in stride that not yet. He will push back in terms of, we are confident. Looks like he will be able to. So that's our outlook of the future. The present, it's what it is, but the future remains certain, and it's because of the transformation that the organization has gone through. I want to stop there and give you an opportunity to interrogate the management with questions so that we can really zero through to what you may want us to focus on. Once again, thank you very much for being houseful.
Thank you, Daktari, for keeping us upbeat. You spoke of that we now look at opportunities instead of beating ourselves up a lot. In DRC, outside traditional mining, where are you seeing upticks that has made it, even overtake us in terms of registering profitability? To Mr. Nyabanda, what opportunities are we seeing locally in agriculture that can help us, that can help our farmers and our economy? To Dr. Korir, the biggest pain point now for how to pay for medical care. What are your experiences around this pain point? Thank you.
Thank you very much, George, for those 3 questions. I think, Brent, you can give them a go. DRC, outside mining, what are the other sectors that are driving that growth? or is it a concentrated mining business? And the second question, what are the agricultural opportunities in Kenya? So Brent, you can go for those two questions. And then Moses, you can jump on that Kenya to add on what Brent will leave out. And I'm saying that, George, because Brent, we said, strategy is equal to agriculture. So Brent can't tell us he succeeded unless we succeed in having 30% of our loan book being in agriculture. So he's the person responsible, but the book is with Moses. And the third question will be shared between Dr. Joan and Ajara. I think it talks of both the demand side and the supply side. How do we make medical care affordable? So, Brent?
So, good morning, everyone, and thank you for the question. So, on the first question on DRC and the opportunities that we see, I think we need to think of our subsidiaries, including DRC, in the context that we operate as a contiguous operation across East and Central Africa. So the opportunities we see in our markets, including DRC, is both a domestic story outside of mining as well, but also the opportunities in which this trade and investment corridor provides, of which DRC is a key anchor to our activities in East and Central Africa. So let me focus on the domestic story. So yes, there is more opportunities beyond just mining. There is the ecosystem around mining, so this is logistics services, or specifically mining services, the FMCG companies supplying into the mining ecosystem, particularly in southern DRC. But we have set up our business such that we are capturing the entire opportunity set in DRC. So it's important to talk about our operational structure to reflect that we've set up the business in terms of management structures so that we cater for the West, we cater for the South, Central, East, and northern DRC as well. Across these markets, we see agriculture as a key opportunity. You'll appreciate that the DRC is 4 times the size of Kenya. It has about 80 million hectares of arable land, of which 10 to 15% is utilized. You will also appreciate that there is significant investment going into what is called the Lobito Corridor. So this is a critical minerals infrastructure belt running through Angola, DRC, Zambia, of which DRC is a key part of that corridor. And important to highlight, this corridor straddles, whilst it's a critical minerals rail corridor, it does straddle across the agricultural potential of these 3 countries, including the DRC. The DRC also has over 100 million population. This is a country where credit penetration is around 8%. There is about 7-8 million bank accounts. If you include mobile wallets, there's about 15 million in an adult population of 50 million. So this is, call it Kenya 20, 25 years ago in terms of the potential of banking opportunities. So agriculture is clear. There is the FMCG, the fast-moving consumer goods. As I mentioned, over 100 million population. Over time, there's a lot of manufacturing businesses that are already catering for what is almost a 20 million population in Kinshasa. So there's a high density of population in a few cities. There is also the opportunity around the asset financing that we see because of the capital expenditure that the manufacturers are looking to do in terms of their investment in capacity expansion, as well as the mining equipment. There is a lot of asset finance opportunities. Also, we see payments. So there's a big focus of the group, not only in DRC, but across the group, around what we do with payments and the movement of money. You will appreciate that the DRC is a cash-driven economy, so our ability to provide these value propositions on making it easier for customers to move money is also a big opportunity for us. SMEs, and SMEs obviously is a cluster of many industries, but SMEs is a big opportunity for us. Similar to what we did in Kenya, the expectation is that we will also grow our SME book. What this means for our bottom line is that, and our balance sheet, is that with this low credit penetration, you should expect continued high double-digit growth in our balance sheet, but also importantly, margin expansion as we penetrate the SME market. But because we're leveraging off digital channels, agency banking, we'll also look to contain the costs, given our abilities and experience in other markets. So to be precise, beyond mining, there is agriculture, there is FMCG, there is SME, and there's big opportunities in what we see in the payment space as well. And then what we do in Kenya, for instance, what we're doing in insurance, we will replicate in DRC as well, leveraging off the infrastructure of the banking business. On the question around agriculture, so agriculture ranges between 20 to almost 40% of economic activity in all our countries, whether you're looking at Tanzania, DRC, Kenya, etc. As a proportion of GDP, it's between 20 and 40%. So there's a lot of opportunities there. But you contrast this to the banking industry, and we can talk about Kenya. In fact, Kenya will probably be the highest, where loan mix of the banking sector is only 3% of their total book. And you contrast this to economic activity of 20 to 40%. So what are we doing? As part of this Africa Recovery and Resilience Plan, it essentially looks at developing value chains. And when we talk about value chains, this is everything from the primary sector, so this is agriculture in terms of farmers, as well as with the extractive sector or mining sector. So these are the raw materials that industries, businesses require. But when we talk food and agriculture, it's everything from the farmers all the way to agro-processing, to FMCG manufacturing, all the way to exports into global markets. So in agriculture, we have a systematic approach to develop the agricultural value chains. And we're working with many stakeholders, including the Kenya government, on developing livestock value chains. We have a big initiative around leather and beef. We have big initiatives also that we'll be looking at in terms of tea, cereals, oil seeds, aquaculture. So we are looking across all the different sub-segments within agriculture. But we're doing it in a manner where we will look to support value addition in agriculture. And this is consistent with the government's, across our markets, policies around import substitution. The learnings from COVID, the learnings from the disruption and the changes in global supply chains is that countries need to be more self-sufficient. So this import substitution industrialization that the Kenya government is going through is complementary to what we are doing with developing value chains and importantly supporting value addition with our manufacturers, our agro-processors. So you'll see more of the activities on the agricultural side. As James mentioned, it's a strategic importance of ours. The intention is for us to move our food and agricultural loan mix to 30% by 2030. So we want to be known as the banker to value chains and not just a bank to SMEs. I think we want to be a lot more intentional in how we connect SMEs into a logical sequence called a value chain. So hopefully that answers your question. Thank you.
The thing I can add is in our target of reaching 30, we are now at 16%. 16% of the entire loan book is in agriculture. Moses, anything you want to add on agriculture?
Thanks, George. And to complement what Brent has mentioned, one of the things we are also quite strong on is using our strength as a group. You've known us as having a foundation, having a commercial arm. So we are working very closely with the foundation in terms of capacitating particularly the emerging farmers and ensuring they do have the right technical skills to enable them scale up. In addition to that, George, the other piece we've done as a Kenyan bank is to ensure we have the right specialists across the subsectors that George has mentioned. That enables us then to map the whole of Kenya and be able to target opportunities wherever they sit. If it's a dairy area, then we're able to deploy specialists to support our farmers in terms of financial capacity, targeting dairy. If it's an area around animal husbandry, similar as such. So we are quite poised to achieve the targets that James has mentioned to move us from that 16% to 30%. Thanks.
Dr. Joan, what pain points are you addressing with Equity Afya?
Okay, thank you, George. So the question was on the strain as far as paying for healthcare services. So if you look at healthcare services and total healthcare expenditure, you'll note that about 50 or at least 50% goes to paying for outpatient services, with only 25% going to pharma and inpatient services, and the final 25% going to the auxiliary services related to health here. So a large cost of healthcare payments go to outpatient services, and that advised the need for Equity to look at outpatient health services as a priority starting point in terms of addressing health challenges and access to healthcare issues. So when we look at trying to manage downwards the cost of healthcare, we noted as well that the aspect of access would be a key driver of the costs, because without the access element, then cost drivers present from even issues to do with transport to access those services, or escalating costs because of lack of timely seeking of health services. You're postponing your care because you have no facilities perhaps next to you. So that advised our very steep targets in terms of how far and how fast we need to expand our Equity Afya network. Over the last 4 years, as you've heard, we've been able to grow the network from 5 medical centers, all in Nairobi, to the current 132 medical centers, all counties of Kenya covered. And now we've rolled out into our next subsidiary, which is DRC. Yeah? So in taking the services closer to people, then we're able to manage the access aspect, therefore lowering the cost. Another thing that we're then looking at is then how do we build in efficiencies into our model, because ours was driven by not just the access element, but also the affordability and high quality. How are you able to safeguard quality even as we manage the affordability aspect? So we've worked with partners, including the pharma partners, because inside outpatients, of course, we've noted that pharma and the human resources for health are the biggest cost drivers. On the human resources for health, we are pleased because we have alignment. The medics that are running these facilities are largely from our education program, the Equity Leadership Program. So we're able to read from the same page when we tell them how can we work together to manage the aspect of cost of healthcare on the human resources for health. On pharma, we are now working very closely together with the bank and its ecosystem of pharmaceutical importers, distributors, manufacturers to see how can we localize manufacture and how can we then strengthen local value chains around pharma to then bring down the cost. So I think we've been largely successful, given that our targets has always been to have an average cost of 2,500, which we currently are around there. It's 2,900, and always exploring ways to bring it down lower. But then we've also realized that it is not in order and it is not sustainable to have our patients paying for their health services out of pocket. And so because of that, we've worked collaboratively with our insurance arm, who are then developing solutions to say, how do we mitigate the aspect of out-of-pocket payments, because it presents a risk as far as empowerment of our communities. We're working very hard on our social impact initiatives to empower the communities. So we want to also safeguard that when they seek health services, that when you seek health services,
Recording
it should not
stopped.
expose you on the economic end. And so that's one of the challenges that we are sitting closely with the insurance team to present a solution for that. Thank you.
So before I hand over to Ajara, maybe Dr. Gatoga, you can come and take the seat in the middle. George, I think the objective was to make health accessible, affordable, and of the highest quality. As we speak, the doctors we have, remember, are the top performance in the country, sponsored by Equity, so that almost guarantees quality. The second thing is the franchise is owned by a non-profit making organization. We have no intentions of making money from health, so Equity Afia franchise is owned by the Equity Group Foundation. That's why Dr. Joan is speaking about it, so that we don't make money. And that was the intention then. How do we bring the benefits of the bank, like its brand, like its capability of procurement, correct centralized procurement, bulk purchasing? How do you ensure the costs are managed by having what she talked about? The target is 2,500, but that covers the cost of tests as you walk in, the lab, then they cover the consultancy by the doctor, then covers the prescription, or the drugs will be provided by the pharmacy, and that also includes if you have a dental or an optical issue, that will be included. So, and that is how we've been able to learn that that cost of all those inclusive per visit. But 2,500 is not cheap for every Kenyan. And so the next step is how do we make it even more cheaper by ensuring it's not an out-of-pocket cost, because if it's an out-of-pocket, it then becomes a problem. And that's when we thought of thinking, how do we provide the country with a health insurance policy that then you don't pay the 2,005 per visit, but you take a policy, maybe 5,000, 7,000, or whatever amount it is, that covers you for the whole year and covers you and your family. And to do that, we have Equity Health. The managing director of Equity Health Insurance is Dr. Gatonga. Gatonga, do you want to speak to the supply side and how you are making health more affordable using insurance?
Yeah, thank you very much, Dr. James, and thank you, George, for that question, and good morning, everybody. So on the health insurance side, as has been mentioned, one of the things the real problem we want to solve there is household resilience as part of responding to our strategy of the Africa Recovery and Resilience Plan. And what we are doing in order to connect what is happening on the supply side and what is happening at the household level in terms of paying for healthcare is to then create insurance solutions or financing solutions for healthcare. And in order to make that very easy and affordable to access, there are about three fundamental things we are trying to do there. One of those is to make sure that we develop solutions that are very simple for customers to understand. And we've done a lot of studies on this to understand what have been the barriers that have stopped people from buying these solutions. One of them is that you have to make them affordable, but at the same time, you have to bring the solution to a simplicity level that speaks to healthcare. So making it, stripping it of a lot of complexities on things like sublimits. So that's one thing. The second problem we are addressing as we roll out this solution is to make sure that it's very accessible, because the health insurance operates, for it to be successful, it operates on the basis of pooling, which means we have to get as many customers as possible into the pool, so that after subsidizing the costs at the service delivery point, we also subsidize the cost through risk pooling. So, and how we are solving that problem is to make sure that we work through our distribution networks. We have a very unique advantage of, as Equity, of having a very wide distribution network covering branches, both the bank branches as well as the equity Afia clinics, merchants, and all of that, to make sure that we can reach the country into all corners and reduce and therefore increase the pool, but at the same time also reduce the costs of bringing these solutions to our customers. And the third important area we are also doing in conjunction with the supply side is to make sure that we drive education. Education in terms of financing, because ultimately health insurance is a financing solution, but also drive education in terms of health education, because one of the things we've also noted as the burden of disease increases is that we need to increase awareness, particularly around prevention, because more than 50% of what we suffer from is largely preventable. So that's what we've put together in terms of health insurance products that we'll be rolling out. Thank you.
Ajara, what has Dr. Gatoga left out?
Thank you, Dr. James. I think just going back to the question, the studies show that 63% of consumers indicate affordability and financing as actually the largest barrier. So even as we design the products and we talk about the supply side, affordability is one of the biggest things that we needed to solve. Now, through our partnership with the bank, we're very fortunate to have Equity Bank Kenya Limited. We've structured insurance premium financing solutions, and we have a blend of two solutions for customers who are corporates and SMEs. And this is for all insurance products. They're able to get this as part of the typical loan product they would get from the bank. But for customers who are retail, we have partnered with Equity Bank Kenya Limited so that they pre-score the customers, they provide them with an automated limit, and as a result, the minute they select a health insurance product, a life insurance product, or a general insurance product, automatically they have a pre-scored limit, which they will be able to access through the Equity app, and in a seamless manner be able to get an insurance solution. We intend to go live in market in Q3, and so we're encouraging customers to join the partnership with Equity Bank, because then you get pre-scored, you get an automated limit from day one, and as such we then remove the barrier of accessing insurance because we already have financing from the bank. The last one which I'll mention is that, as I'm sure you know, life insurance solutions also have an option to provide a policy loan. And as such, any customer today of Equity Life who's consuming a long-term product or an endowment product, you're able to get a policy loan of up to 60 to 70% of your current savings and be able to apply that at concessionary rates to be able to access health insurance. So you can see from a collaborative perspective, we have the bank, we have other insurance partners, we have the technology business, and we're able to provide you with insurance solutions through the app, easily accessible, and be able to do that to provide you with healthcare solutions, but also other solutions you might need for personal as well as business needs.
I think if I summarize it, George, that the sponsor of Equity Afia is a foundation that is not looking to make money. That really significantly removes the profit portion, which is normally maybe 20–30% of the cost. The second aspect of it is a controlled franchise by people who are convinced that they want to change society. They are giving back. To those much has been given, much will be expected. And we are really glad that the doctors agreed to be charging just 500 shillings for consultancy. You could compare with this KAID. When it comes to quality, accessibility, and affordability, we are ranked at the same level with Nairobi Hospital and Aga Khan. So that's the level of quality and affordability. But lastly is what has been said here. We guarantee you quality, we guarantee you accessibility, but we have now addressing affordability by bringing insurance, such that we are jointly bearing the cost of insurance. It's not the person who is sick, it's the market, it's the population. And so the premiums are fairly affordable, but not maybe to everybody. So we have developed a premium financing, and I'm glad to say 50% of all the insurance policies we have issued are financed by Equity Bank, and we are very grateful. And that is why the offtake is such strong. The next question comes from Boniface Shege. Going into the new year, what's the plan with Equity Afya? Will we see investment in regional level 5, 6 hospitals? Is there a plan to take Equity Afya into markets beyond Kenya? I think Dr. Joan has answered those. Boniface has another one. Dr. Mwangi, my startup is targeting Kenya shillings 500 billion market with a unique value proposition designed to solve real estate industry. As founders, we operate in a dynamic and resource-constrained environment, balancing innovation with limited access to capital. Given Equity's bank's commitment to supporting entrepreneurship and financial inclusion, what strategic advice would you offer on securing the right financial backing, forging impactful partnership, and scaling efficiency to capture a significant share of this market? I think I would invite you, Boniface, for a cup of tea, and you provide me more information, and then we'll be able to respond to that. But before you come, I would refer you to somebody who had a similar value proposition, a company called Octiven. So if you talk to Mr. Washiori, we co-created, and he has now provided our diaspora with a solution of owning a home in Kenya, almost guaranteed by Equity. So if you could talk to Octiven, then you can come. We then design and co-create your product. Another question? Yes, please.
Thank you very much, especially for making so much money for us. That's why I have an issue. Yeah, good money. I can see why you took a little bit longer to count it this year.
It is true. 60 billion is not little money.
That's why I can understand. It took some time to count. Now, on the issue of dividend, since we passed the law between 30 and 50, for 3 years you have remained too close to the minimum. Today is 34.5%. In an area where some of the competitors are giving 80% of the earnings per share. Being that close to the minimum puts you in a reluctance corner. Why am I not finding you in the top half of the range when it comes to dividend? And when you have invested in a company where dividend is guaranteed, that dividend is an important input in household income. And many of your shareholders are people who that also addresses the issue of income inequality, one of the disasters we have in the world now. So can I encourage you to move towards 50? Thank you.
Thank you very much. It's true the dividend payout policy is between 30 and 50. And Brent, is it 50 or 40? 50. And it's true we have averaged in near the lower minimum for the last 3 years since the shareholders passed that resolution. But if you look at it, it's how do we finance the subsidiaries? So you'll see, although DRC made a lot of money, and huge money, we are very, very encouraged by DRC. It's not able to pay dividend, simply because it is growing faster than it can fund itself internally. Last year, but one, we had to fund it. Despite the profit is making, huge profits, we had to add another $70 million to capital injection. And that explains why that state is in DRC, that state is in Tanzania, which has really now recovered and seems it's trying to catch up with the others. So it's constantly we are putting capital. Uganda constantly putting capital. So the only two subsidiaries that are making money and paying money is Kenya and Rwanda. And as you can see, Kenya is 50%. So if by the time the others start reaching where Kenya is, that whole 30 is by one subsidiary, Kenya, and that is why. And yet the subsidiaries that are not paying are still asking for dividend, for capital. So what we are doing is to build a future for our shareholders. And we are very excited that we are using dividend of the slowest growing market, Kenya, and investing in the three fastest growing economies in the world: Uganda, Rwanda, Tanzania, and DRC are in the top 10. So we're saying, do we allow this opportunity pass our shareholders? And we're saying, let's do the delicate balancing act. Let's give them as per contractual obligation, but also ensure that the future is becoming brighter. So I'll maybe have a cup of tea with you to dialogue. How can I balance that better with the team? But the objective is to create a future. As you see, it took Kenya 16 years to reach a 4% return on asset. It took Rwanda 14 years. Looks like DRC would do it in 12 years. So what we are seeing is that we are making better bet for our shareholders. And as you heard Brent said, only 7% of the population of DRC has bank accounts. Loan to GDP is only 8%. Kenya, we are at 32. You can see the runway, how large the runway. So we need to balance that, but it's a conversation we need to have. Do we miss the future? Or do we balance the present and the future? And as we all know, wealth creation is not a function of the 60 billion. It's a function of how much we save to invest into the future. That's how you create compounded wealth. So it is more of paying today, consuming today, or creating bigger investment in future. And that's what we are. The last one I want to say is our brand has become iconic. So what happens is that the European banks and international banks that are exiting the market, we have become the first point of call. And now you can see, you look at Koja Bank, you look at ProCredit, you look at BCDC. To do a startup in such a market like DRC would be almost impossible. So again, we are always ready that these opportunities are being shown to us constantly. And you can imagine the discipline of saying no to maintain the 30% rule on dividend payout. Yet, this is a one-in-a-lifetime opportunity. You could imagine now there is no European bank in DRC. The two that were there were taken by equity. If we missed that, it means it will be a startup. And a startup in such a market would be difficult compared to taking a BCDC, which was being consolidated with the European banks and had been in existence for 120 years. So that is the decision that always confronts us. Opportunity for the future and consumption of today. And building resilience. Another question? Yes.
All right.
Yes.
Yes. Good morning, everyone.
Morning.
My name is Jimmy Mbogo from Citizen TV. A couple of questions. One of them is on non-performing loans. Could you give us the actual figure in terms of how much are you holding in non-performing loans? And also, what is the spread in the region? When you look at the different markets that you're operating in, what is that spread? And for Kenya, in what sectors are you struggling with non-performing loans? And number two, on interest income, could you tell us how much of your investment in government securities contributed to that?
Alex, in a detailed paper, I'm glad we'll give you a very detailed that has answer. Maybe you could project that slide, Alex. Not in the summarized version, in your printed version. It's on NPLs, it's in their own section. Not in the summarized paper, in the big, the printed copy that you are handing over. Or you can pass to me. Very good. On this one, Alex. Very good. I wish we could have seen this together. I hope it's on page 44, if you're able to project page 44. So the NPL issues by segment, the one that we are struggling most is corporate. And I'm sure you know corporate mirrors the pending bills. That's purely a matter. That is at 22%. SMEs are at 13%. So as you can see, and the average is 22. Our best performing segments are retail and public sector. Alex, page 44, if you can project so that everybody can follow for themselves. I think our biggest challenge in terms of concentration is Kenya, which has 17, Uganda 14, and straight we drop from there. Equity BCDC is at 5.7. And Equity Tanzania 3, and Equity Rwanda 4. So as you said, Kenya is the most integrated, but as you can see, you can relate directly. It's corporate, and it's the corporates that are holding the non-paying. For the group, the NPLs have declined from 13 to 12, if you combine. The average for the banking industry is 16, so we are 400 basis points lower than the industry. In terms of coverage, coverage is at 71% on cash basis, and the balance up to 103 is covered by credit guarantees. So this is coverage of 100% without putting into consideration the value of securities. So it's full provisions, and that's why we said we have not carried the risk of the past. We opted to do. Alex, I would really appreciate if you could put that slide is on page 44 and 45. But you get this booklet, so if you didn't get the numbers, you get it, it's ready. Another question, yes, Kemoda.
Thank you very much, Daktari, for the good work for the year. As you have said, the year had a lot of challenges, but generating such a profit and also giving us that dividend, though may look constant, that's you deserve a pat on your back. Now, I have two questions and one observation. And one question is about, you said that a lot of your transactions are now digital, and that's very good. But And I also thank you because there has been a lot of sensitization about this thing of people telling you, can you call this number? And in the process, you see those people who are not informed end up losing a lot of their money, either from their account or from the phone. Now, I don't know how strong is your IT department, so that whenever I am called by a number, and I may not be, maybe I'm imagining of my mother in the village who may not know that Equity will call you on this number, and then somebody calls and tells her to do ABCD, and then she ends up losing a lot of money. So what measures have you taken as a bank to make sure that your savings, the savings for your customers is safeguarded? That is one. Number two, you have said that you are projecting your cost to income ratio to go between 48 to 50%. And yet you have also told us that we are experiencing 6 shocks, although some have gone, but there are still some shocks like geopolitical and what is happening globally. Now my question is, how are you confident that in this year under review, you are able to increase your income and to reduce your cost so that your income ratio may be between 48 to 50%, or you might be a bit cautious and say, even if it remains at 56 or 58, there is no problem in that. And then lastly is, you have said that in 3 years there have been 14 million policies as far as insurance is concerned, and that is very good. Then becoming number 2 or 3, that is very good. But my question is this: what is your target for 5 years? Because if you have over 21 million customers, and so far you have 14 million policies, I'm thinking that by now, maybe around 18 or so of your customers, about 90% may be aware of these policies, and maybe they have taken it. So what is your projection in the next 2 years as we celebrate the 5th year? Otherwise, I wish you well. As you have said, the pilot never loses focus because of the turbulence. He keeps ahead to make sure that where he is taking his passengers, they arrive safely. And so we are sure that we, as your passengers, Daktari, and your management, you will not divert and go back to the airport you came from, but you will take us to where our destiny is. Thank you very much, and have a very good year 2025.
Thank you very much, Bwana Kimodo. Very encouraging words. You know, the reason why we are able to do this passionately and enthusiastically is because of the support we get from shareholders, and such a powerful statement of understanding the environment. But let me say this, Bwana Kimodo. We said there are 6 shocks concurrently that we are dealing with. But we said it appears shocks is our new way of life, that the path will have shocks. So we have to learn to navigate roads with shocks. Eke, the bird, says she has learned that the hunter has learned to shoot without missing. And Eke bird says, I have learned to fly without patching. We have learned how to manage business amidst shocks. And that's why I said, and I spent a lot of time, we had to transform equity so that it's resilient. And we transformed equity from strategy, from governance, from people, from systems, and from customer offering. And the objective of each of these forecasts is to create resilience with the offering that we are making customers. Resilience in our staff, resilience in our systems, resilience in our governance, so that we could be able to ride and be able to operate in an environment that we don't expect to go back to the old days where we could guarantee We have missed targets, not just for last year, and it's a little bit embarrassing for me, because for 25 years, we were precise. We could tell shareholders this is where we'll be, and that's where we'll be. These shocks, normally we plan without them in mind, and then they show up. While you are dealing with one, another one, as we said at the moment, we are dealing with these 6 simultaneous shocks. So what we have done is then said, how is a business operating model in a turbulent environment, in an environment of continuous shocks? And we hope this year will surprise the shareholders by surpassing and exceeding the projection. So we are testing ourselves. Have we built the human capability that can think differently, that has seen it, has experienced it, and that capability is now in the bank. We're looking at system and saying, do we have the tools that will allow us to navigate and change direction quickly? Do we have the agility of the balance sheet that could allow us to do? And one of the reasons of going agriculture 30% is that agriculture is the most resilient in the marketplace. Remember, the only sector that grew during COVID was agriculture, because people had to eat. So we've said, how do we insulate ourselves using a domestic capability? Because food in Kenya is normally domestically produced to feed the population. So that will remove you from the global shock significantly. So we will work together and ensure. I think on the cost income, yes, I appreciate the suggestion you have said, cut the cost, but we may want to grow revenue. And one of the ways of growing revenue is reallocating. If we look, 45% of our balance sheet is in sovereign risk. Sovereign risk is the lowest yielding asset class. And now we are focused, whether it's in agriculture, let's put these assets into credit. And that alone would increase income by 30%, even without touching costs. And that is why we are very optimistic that we should be able to take it to 48%. And I appreciate the skepticism, moving from 56 to 48, but you can hold me to that, and we can test it with the first quarter. Are we moving? We will not be at 48 because we are moving from 56, but are we making progress towards 48? And I believe, I'm confident that we'll add around there, and we shall go to our destination. For sure, the transformation that has occurred to the group gives us significant confidence about dealing with shocks. And again, as I said, it's not about expense, it's also about revenue. As Angela, you prepare on where shall we be in 5 years, from 14 million, what position, what contribution of the group revenue will be coming, when will be, what percentage will be the balance sheet size in 5 years. Let me deal with this issue of social engineering, because that's what our customers have. We are spending a lot of money to advertise, to sensitize to our customers that we will only call you from one number. But you notice that once you open to a fraudster, then what they do is socially, mentally engineer you. You lose track, you cannot see who they are. And we have encouraged our customers as much as possible, don't engage with fraudsters and give us a number. Unfortunately, these numbers calling the customers, we have no visibility because it can be any mobile network that is calling you. And the way you are acting as normal because it is you. It's not the fraudster who is managing. If it's the fraudster, we can tell the difference between behavior patterns. But because it's you who is operating, you're operating your accounts as if it's normal. So, but what we have done is to use significant resources on AI and we are really using artificial intelligence, and we have created significant agents to help. I'm glad to say, where is the compliance level, Wafula? We have reduced social engineering frauds by what percentage?
I think about 30%.
30%.
Yes.
So you can see we are working round the clock, but you can see we are doing it without visibility of the action. But AI, we have invested heavily in AI to monitor. Then every fraud occurs, we feed it to the AI and say what is unique about this, and then we pull that as screening of all transactions. So we are making every effort because one fraud is too many, because that might be the only money a customer has in the account. So it's not about how many. It should not happen to any customer. One is too many. And so we are investing ourselves a lot. The IT team, is there anything you want to talk? The fraud risk, is it Charles? Is it Peter? Who wants to make a comment? Naftali, yeah? Naftali is our head of security.
Thank you, Mr. Kimodo, and Chairman, as you, Dr. James, as you have indicated, social engineering is actually a menace, and there's so much intervention that we have done. As indicated, the problem is that these are people also coming from other networks, and we have gone ahead to even involve the commissioner of communications, because we want to say where these lines that are being used to call, and how do we also ensure that we do have a way of preventing and also registering. If you look from a banking perspective, and those calls coming from Equitel, they are all registered, we can trace them. The other numbers are coming from other sectors, and you see they have gone in a way that you can have so many SIM cards, and that's one area that we have sat with the police. We have a network, and we have grouped ourselves with a team within the law enforcement agencies to track those people. But the key of involving, bearing in mind of centers like Mulot and prison centers that actually propagate some of these evils. But within the bank, and there is also intervention and rolling up of a program with even new system that deal with machine learning and AI as have been put across just to try and address this particular menace. So what we're doing as a bank is a lot of intervention, data analysis, and also trying to bring on board on how do we protect our customers. And it's actually one of our key agenda that we sit and we review on daily, and we update on weekly basis to see what's the threat, how can we protect our customer. That's what I can add.
It's an industry problem. It's a nation of value systems problem. So the best way is to protect the customer, and that explains why we are spending money to sensitize the customer so that they avoid being social engineered. Ajara, I guess you now have the future. You can share with us.
Thank you, Dr. James, and thank you for that question. I think I'll start by taking us back to the overall group strategy, which is the Africa Recovery and Resilience Plan, where, as highlighted previously by Group Strategy Officer Brent, Equity Group is looking to target or achieve 100 million customers in the markets in which we operate, and those customers would be consuming various solutions. Now, when you look at the Equity Insurance Group, this was the short-term goal. We had said that we had intended to have, by 2030, 4 million customers. I think you can see we've already breached that. If you look at the 14 million customers, 5.9 are unique policies. So that tells us we've already achieved what we had targeted to do within 2 years and 8 months. And that is really a demonstration of the strength of the distribution capability within Equity Group. Now, going forward, we've realized that the one thing we want to do is ensure that we are bundling our products. As you well know, the banking business does well to create wealth using credit, but then the insurance business then comes to help customers protect that wealth, protect life, or protect health, so that we have a holistic value proposition. So the first thing we want to do is ensure that all of our customers consume at least 3 insurance solutions: 1 life solution, 1 health solution, and 1 wealth solution, which therefore means that as we look at Brent's target of ARRP of 100 million, the natural number we would be looking at for insurance policies is 300 million policies. I still think, though, that 300 million is low, because previously Dr. James has talked about use-based insurance. And use-based insurance is where we want to provide insurance as a service. Our customer is traveling from, Nairobi to a certain town in Kisii. We want to be able to provide them insurance for that journey. That 100-kilometer journey, and that is a single policy. So we want to move from having annual policies which are paid in advance. We had talked about the fact that they're very expensive, to use-based insurance, where customers enjoy insurance solutions as they have a lifestyle. Today, if a customer is taking a flight from Nairobi, let's say, to Mombasa, they can just take an travel insurance policy for that flight alone. And so we believe that we should be able to have customers consuming on average between 6 and 8 insurance solutions. I'll let you do the math because you can now see we're in millions. But as I said, that's more the capability of Equity in terms of distributing. Now, from an industry perspective, currently, if you look at the markets in which we operate, the insurance penetration is 1.34%. The highest penetration is Kenya at 2.3%. The lowest is DRC at 0.4%. Our target by 2030 is to double insurance penetration in the markets in which we operate. The last one, which Dr. James asked me to mention, is what proportion do we believe the insurance group will contribute to the overall PBT? We're currently sitting at just about 3% of overall group PBT. We are targeting to have double-digit contribution. However, as we mentioned, as the banking group, as Kenya wakes up, as the DRC team wakes up, you can tell that it's going to be the race of a lifetime to ensure that we can get to double-digit contribution. So thank you for the question, and I hope I've answered the brief, but also made the future commitment from the insurance group.
Not so quickly. Katonga, Dr. Helen, so Dr. Joan, can we be able, Equity Afya and Equity Insurance, be able to provide Kenyans with a universal health policy? Dr. Joan, you can go first. Yeah, you're on the surprise side.
Okay, so universal health coverage is about availing healthcare services that are affordable to communities and that can access them without financial crippling through access of healthcare services. So when you look at that definition of universal health coverage, you can see that as the Equity Group, we are on course to deliver on that, and we're doing it in a very structured manner, yeah? Because we're working on the aspect of the access through the health service medical centers, and we've also been challenged to also consider inpatients even as we further expand access, yeah? So as I mentioned earlier, we're also looking at the aspect of how we safeguard our communities from financial ruin that can result from seeking healthcare services that are sudden and perhaps of a financially crippling nature. So we are on course because we realize it is when the various countries where Equity operates speak about health, you'll hear all of them defining universal health coverage as a common denominator. So we are on course and we're doing it in a very structured way to ensure that it's well delivered.
Katonga, is there anything else to add?
Yes, so first of all...
Can you make it possible through a policy for all of us? We share health burden.
Absolutely, it's very possible. And one of the two unique things we've done is to make sure that the health solution that you get is a solution that's very flexible. You can buy whatever you can afford. If what you can afford is 500 shillings a month, you can buy a health coverage for that. If what you can afford is 50,000 shillings a month, you can also buy health coverage for that. So there's a huge element of universality in the solution. When you combine that with the flexibility we talked about earlier in terms of payments, in terms of insurance premium financing, that is very possible.
I think broadly, another what we have done and on what Dr. Katonga is talking about is to ensure we are able to take a healthy policy who's inpatient is only in faith-based hospitals. You can imagine how that comes through. Another one is where we give you a coverage for outpatient, you go to Equity Afya, but in case of admission, the policy is for a public health hospital. So you can see the cost, then it's fed to the pocket, or you make the choice. But if you can afford and you want health in a 5-star hotel, then you also pay the policy of a 5-star hotel. You are in a hotel, but you are receiving health. And so you provide everybody with what fits them, not a one fit, because that has been the problem. We are given one policy, but we can't all afford the same policy. So we'll look at that. Alex, are you able to project that page 44? Because that question was of interest. It was pertinent. So that, yeah, very good. So this is the NPL issue that we are being asked about. And you can see the problem we are talking about NPLs in the country is not an industry, it's a sector. And you can see the correlation, the relationship between corporate and SMEs. When corporates are not paid their bills, then they don't pay the SMEs who populate their value chains. But you can see, so it's it's a concentrated risk. So for us, I think we are talking about 12 loans are causing that corporate. So if we deal with the 12, we are confident this year we'll be talking about one digit. We can see the trend from 13.4 to 12, and we can see the coverage. And you can see this quarter is the best coverage we have ever had for the last 5 quarters in terms of coverage. And that's why we said we are more focused on the quality and ensuring we don't carry the risk of the past into the future and return dividends. So this brings certainty as to how we manage the bank, conservative. And again, we can see the countries that are having challenges. Again, it's a little bit of concentration. Looks like, Christine, Uganda should be single digit. Look at Tanzania. Tanzania 3 years ago, if you remember, was 39. Last year it was 13. Look, we are now 3, and hopefully by the first quarter we'll be talking about 1. So there are problems we can solve. It's just timing. I'm sure you are seeing too many headlines of Equity resolving those few. So we believe this year will be our year of resolving. And if we resolve all those approximately 17 loans in the entire group, and if you look at in absolute number, we have suspended interests of about 23 billion. That can quickly swing back into profit. That is not provisions. Provisions, as we saw in the next page, Alex, it's, as you can see, 78 billion of provisions. Suspended interest out of that is 22. So by collecting those 17 loans, you see that swings, and we expect pleasant surprises this year. And what we are talking about, the average industry is at 16.4, while we are 12.2. Speaking about the quality, despite the storms, the shocks, our performance remains pretty. Is there a question at the far end there? Before we say thank you for, thank you, I can see no question, I can't see question, and make it very brief.
Thank you, Dr.
It's on.
Thank you, Dr. for the invite. Let me say this first, that you and I are cognizant of the fact that incredible leadership is the bedrock of every success in any given company. I want to appreciate you for being the powerhouse that you are and the equity's finest. Allow me in this moment to welcome the new management, the new managers who came to this institution, and to tell them to give this company a touch of quality and a taste of excellence.
A touch of quality and what else?
A taste of
a
excellence.
Taste of excellence.
Can you clap for that?
That's truly. Professor Macharia, Chairman, on behalf of the shareholders, that's what the shareholders want. Help me to hold management to account.
A touch of quality and a taste of excellence. And I want to say three things. That you do the right thing at the right time. Do not be complacent so that we can be stronger together. Can you underline? Do the right thing at the right time. Do it as a family. Now, I have one question. I wanted to reserve it during the AGM, but it is pressing me. It's about confidence restoration and customer centricity. How does the institution or organization ensure confidence restoration to customer centricity?
Very good. Liz, where are you?
There is another one.
Oh, okay. I wanted to shoot it straight to the Director of Customer Service. Liz Othiabo. Okay.
Another one is for the startups. As one of the giants in the banking sector, what role does Equity play in offering support to Kenyan startups by offering access to credit and funding?
Very good. So, Dr. Joan, you take the question on support for startups, and Moses, you own the customers. Your director never showed up, so take the question.
Thank you.
And where is David Segawa? Be prepared. What are you doing to guarantee what the shareholders want is what staff deliver?
My name is Sally Chepkorir.
Yeah,
For those who might not have seen me since the world was created.
And also Director of Strategic HR. You hear the imperatives from the customer. What assurance can you give? Sorry, shareholders. Sally is a shareholder. So, Moses?
Thank you very much, Sally, and for putting us on the spot. Customer is the center of what equity is. And where we sit as management, we fully dedicate ourselves to ensuring our level of customer service is at the highest. Without a customer, we can't be paid. And we are very cognizant around that. So the pertinent question you've mentioned around what are we doing to restore customer confidence? I think Dr. James did quite elaborate. There are many facets we are dealing with. One, we've seen the stability that we've put around systems, and that has taken significant investments to ensure that first, we're able to serve you seamlessly so that you're able to transact when you want, how you want to transact. That's quite important in terms of ensuring that there's reliability around what it is we promise you as a customer. You've talked of the management team and you've put us to task around that. The team that's there is then to also drive a lot of innovation. One of the things we are looking at around customer centricity is to develop products that talk to you. If we just generalize products, there won't be centricity. So even as we talk to you today, one of the big asks we have is give us feedback around what it is you want. Our DNA now is approaching customers and telling them, tell us what your dream is. Then we are able to develop something that tailors towards that dream so that it really talks to you as a customer and provides you a solution as to what it is we are looking to. The last one that I would want to talk to, and Dr. James did talk about it, is the overall governance around the organization, starting with the board, and the chairman is here. So board holds us as management totally to account to ensure we're able to deliver to you. But even within us, we've provided proper structures and proper checks to ensure that quality levels are at the highest possible. As we do that, we are also transforming to ensure that we are almost with you at par when you're doing transactions. So our level of monitoring, our level of digital solutions are also going to be up there to ensure that we're able to serve you fully as you do wish. So it's one, Sally, that we focus significantly a lot. It's a daily conversation for the management team of, are we in touch with what the customer really wants? And that's a question we keep asking ourselves every day. We need to continue doing that. We'll never stop because the customer needs also evolve as we get to do that. Dr. James, let me touch a bit on the startup question before I hand over to Dr. Joan. We do appreciate, and what made us who we are as a bank is being able to carry customers from startup to ensuring they develop through the motions to become large SMEs or very large corporates. We don't want to lose that. So where I sit as a bank and together with my other banking colleagues, we are quite cognizant that the true DNA of Equity is actually around startups. That's what made us. That's what will continue to thrive us, because we're able to walk with you from a startup till you get to a large corporate. Then we've transformed you. We're able to live what our vision and mission is as a group. So we're working very closely with the foundation to ensure right levels of capacitation happens, so that when you become bankable, then we hold your hand from there till you achieve your dream. Thanks, Sally.
I think, Sally, what you're asking, so we're saying our vision is an African vision, ensuring nobody is left behind. And it cuts across all the sectors: agriculture, mining, energy, environment, SMEs, so that we are covering communities. It's not necessarily individuals. But what I liked most is what Moses pointed out to you. We shouldn't be giving you products. We should be giving you solutions to your needs. So we want to really educate customers, not to come and ask for loans, but to ask for solutions. For what they should be able to articulate most is what they want to achieve. What Kemodo said, we have a destination. How are we getting there? Help me to get to this destination. This is what I want to achieve. Because when they come to ask for loans, they prescribe the loan, and yet they are not experts in loans. But if they give us the problem, then we'll be able to provide a specific solutions. And that is why the product house has become very, very powerful. The second one is test us with the experience. We no longer want to be known as a bank. We want to say it is the total experience. It's product, it's channels, it's systems, it's governance. It's how we make you feel as a human being. It's your dignity. It's your honor. And the opportunities we are partnering to open for you. Really living to the purpose of equity. Giving dignity, changing lives, and expanding opportunities for wealth creation. That is what we want to hold ourselves to. And as Moses said, we are an inclusive bank. I believe the most inclusive bank in the world. What it means is that we acquire at the bottom, at the micro level, and then graduate people from micro to small to medium to large and to corporate. And we are very proud the journey we have walked, particularly with Kenyans. And that is why, as they grow, that's the only way we can grow. Equity doesn't grow. The numbers we are talking about to 2 trillion is not equity. It's the aggregate of what customers have achieved. The bigger the customers, the bigger we shall be. There is a perfect alignment, and that is why. And that is why, beyond that dream, we say, what can we do to capacitate and de-risk everybody, particularly the startups? And maybe we are doing that a lot from the foundation and from sustainability. So a few words, and then I hope, Oscar, you also have your mic. What are you doing for small businesses for sustainability? Joanne, go first.
Okay, thank you. So on the foundation's end, we're working closely with the startups and supporting them to graduate. As has been indicated, our input is largely around knowledge and capacity enhancement, then linking them to the right tools that they would require at whatever level or whatever sector in which they are playing in. So one of the additional things that we've done as far as that goes beyond the customary MSMEs that we've had, we've realized again that the young people have a very heavy leaning towards technology and innovation. So we launched a program last year to also see how we can bridge that capacity building towards establishing MSMEs for young people that are focused towards tech and innovation. So we set up a tech and innovation hub at Start to City to offer them those skills, upskilling in whichever sector they are focused in, whatever sector they are trained in at university, and then be able to link them with whatever financing tools they require to be able to start businesses should they require to.
And then there is our big program, Young Africa Works. How do we get those startups to function? And we provide them with financial literacy, entrepreneurship training, and we also provide them with guarantees because they don't have credit. So we've partnered with Africa Guarantee Fund, we've guaranteed with IFC, such that those without credit, they pay just a small amount for guarantee. So everybody now can access credit. But the most important thing is to de-risk them and to capacitate them so as to be able to get. And you do that through training and de-risking them through guarantees so that nobody is being left behind. David Saga, yes. Oscar, what are you doing to make this a sustainable journey?
Thank you. So just to add to that, the next stage really after we've capacitated and worked with the startups is connecting them to other stakeholders within the ecosystem. The accelerators, the startup incubators that can provide access to other types of capital as well, private equity, etc., but then also connect them to other businesses across the continent. So we're working with UNDP, for example, with a program that they have across different accelerators in the continent, and to see how we can plug in and help to support those startups, particularly in the technology space, but then increasingly in some of the other spaces that impact the young people of the country along the creative sector, the sports ecosystem as well. So we're looking at those sectors as well. And then helping them to drive, include sustainability within our product offering so that the work that they're doing, the infrastructure they're trying to build, is built with an end to ensuring that there's a low carbon footprint, that it's environmentally cognizant of what needs to be done to ensure that it's all sustainable. So there's multiple efforts we're doing also from a funding perspective as well.
I think the biggest I've seen him do is startups in agribusiness, because we are seeing a lot of our young people going to innovate in agriculture. And last year, we were named the bank with the highest number of loans for mitigation and adaptation to climate change. So how do you ensure micro or small or startups in agriculture survive the shock of climate change? And so we have this huge capability of mitigation and adaptation loans. I think Tatu was talked about. We have put 415 of first-class students, 84 points at O-level together, and said, can you create Silicon Valley for us? That's a team that has been said to be in Tatu City, and their patron. I've obtained an expert from Silicon Valley. Why don't you take a little bit of mic and tell maybe Sally what you are doing. Johnny is another graduate of Stanford University in Silicon Valley, then a master's degree from Harvard University, and said, this is the brightest of the brightest brains in Africa. I want them to succeed the way the Silicon Valley succeeded. Where are you in succeeding?
Good morning, and thank you for the question. We're very happy to share that the young folks who've been upskilled at Tattoo City have joined the group and are very busy internally working on solutions. I love what Moses said, because Tattoo City in that program, the innovation program, it's a sandbox environment and it's a solution center. It's where people bring problems and it's where young people actually develop solutions. And then we invite the rest of the group to help develop products around those and bring those to market. So we're advanced with that initial cohort, and we're looking forward to launching a 2025 program very soon.
We don't want just our businesses to be called Juakali. We want our startups to be in the technology space, the innovation space. And the team that I talked of 24 that is in India is looking at how we can create a digital public infrastructure for these young people so that they can play in an innovation center where the cost of infrastructure is put up for them. And hopefully that is how we'll create Africa's unicorn. I have no doubt. In just a short period of 1 year, they have been able to create 45 IPs, solving our problems. So as they mature and we expose them globally, I have no doubt they will provide global solution. Esagawa, and then I hope Victoria, you have also got a mic.
Thank you, James. I think I've been requested to talk about customer centrism and customer experience. And I would like to say that customer centrism is actually a core part of our corporate philosophies and our culture. And that is a strategic discussion we have at all levels of our organization, whether through induction or ongoing business discussions. But I think most important is the fact that we now have developed a structured way of not only collecting customer insights real time, but also reacting to them. And that's why at every branch we have, and every organization department.
I think the question was on people. How do you create a culture of people doing the right thing? Was the three things, right thing, at the right time, without being, it was about culture.
Do the right thing at the right time. Yeah. Do not be complacent. That's number 2. Number 3 is stronger together.
So it's about culture.
Yes. So as part of that culture, to embed it, number 1, we put it in a structured way within the way we track performance, to the extent that every employee today has a key performance indicator to articulate how they contribute to customer centrism and how that culture of customer experience is embedded into what they do every day. So every employee is holding themselves accountable for improving customer experience in whatever they do.
And there is quite a lot of going to that culture so that people believe in our philosophies, our ethos, and corporate philosophies, such that they are not just on the board that this is, you can see the core values there, you can see our service charter. So we don't want them to be on the walls. We want them to be in the minds and hearts of our employees. And so we are doing that through a cultural immersion and also performance management, so that, as you rightly said, we constantly remind people with a daily dashboard, this is what your performance should look like, this is how it should look like, and we have no challenge with separation if it's necessary, because you can only invest so much. It must be in the person's mind. So accountability for leadership and governance.
Thank you, James. In terms of doing the right thing the right time, I think we are also looking at it from a governance level, and this is really cascaded right from the board with the responsibility that we've been handed over, where we are not only looking at what David is saying, performance, we're also holding accountable all leaders, including the MD, starting from the MD position. So gone are the days where we will go for the clerk. All this has to start from the top. If there's a problem down, definitely it must have started from the top and we cascade So that is really an area we are looking at. Culture, as has been said again, is a thing we are rebuilding. We want people to live it daily, not necessarily just it being a separate matter. It's our way of operation, and that will go in even to the customers. We'll get to feel what is the equity culture, what is the equity way, a way that we listen to customers, and it's starting from us creating an environment within the organization. So definitely providing employees, everybody, all staff, the right tools that they need to perform and the right skill set, upskilling them as well on a constant, and we also have regular engagements, because as a listening, caring partner, we are not only listening to our stakeholders out there, we also want to be able to listen to the staff that are in here, because they are also in the marketplace to bring us the information. So we create an environment for them to be able to then have this so that we are able to do the right thing, right time, and not be complacent. Thank you.
So it's the equity way. Allow me to invite the chairman. I'm so glad that we ended with a question about from a shareholder and what they would like to do. Maybe that is above my pay grade. The only person who can assure shareholders is the chairman of the board, Professor Macharia.
Good morning, investors, senior management, and our customers. Thank you very much, James. You know, the day of releasing financial results is the day for management to shine. The day for the board is the day of the AGM, but there is always the intersection between management and the board. And we've had the last question that has been dealt with refers to governance. And governance is at the center of the growth of equity. And we recognize that governance is very, very important. Many organizations have grown and turboed down because they didn't take care of their governance structures. I must say that at Equity, we have realized the importance and the centrality of having a very strong corporate governance structure. I want to assure investors, our customers, and also our admirers that we have put a lot of thought into structuring governance structures that also take care of succession. I know within Equity and outside, succession planning has been a very pertinent issue that has been raised. We've shown that as the organization has grown and the board has realized that we must create a fit-for-purpose organization, we've gone all around the world to recruit talent that will take us to the next level. As you have seen today, when talking about the strategy team, I think only one person is more than 3 years. It's not that we didn't have a strategy team, but we realized when we developed the Africa Recovery and Resilience strategic plan up to 2030, that we needed to boost what we had internally. The board has not spared any efforts, has not spared any resources for us to get the best in class for every department in the bank. As we have developed management, the board has also gone out of its way to make sure that both our group board and our subsidiary boards are also up to the task. You can't have very highly skilled, very highly exposed management teams, both at the group and the subsidiaries, and then you have board members who are not as skilled or as exposed, because they are supposed to oversight these very highly skilled management teams. So if you look at our group board, you'll find that almost half of our board members have been recruited globally from all over the world. They have been recruited for their skills, they have been recruited for their exposure, and they bring that global view and outlook. They bring that global so that they can challenge our management teams to think not only globally, but also to be futuristic, because we are an organization that is growing. When you look at the demographics of our customers, the demographics have greatly changed. The requirements of our customers are changing constantly. We have realized that at the intersection between our customers and the bank, we are there. And we are not just providing banking services, we are enabling lifestyles. So we have to think different for us to be able to enable lifestyles. Remember, these are people who want to consume our products 24/7. They want to make sure that where they are, wherever they are, there is no geographical restriction, there is no time restriction. And that is why, again, we have also invested huge amounts of money in making sure that our systems are not only stable, they are reliable, and they are very efficient. So I want to assure our investors, and we are very grateful for the loyalty of our investors. Our investors have really stuck with us. When you talk about our dividend policy and the questions that arise, and I do understand as an investor also that I want to get much more dividends. But then there is always a question that sometimes you have to have some delayed gratification so that tomorrow also you will get gratified. If you note at our expansion in the region, you will find that this has been funded from internally generated funds. We have bought or we have acquired some assets, like we acquired in Rwanda recently. We did not borrow money for that acquisition. We used our retained earnings, we used our internally generated funds. What I mean is our investments today will enable us to continue getting that 30 to 50% dividend even for years to come. And we all look forward to continuously increasing our dividends. We cannot be, as a board, be reckless to give everything and then we have nothing to grow. Those of you who has been investors in equity, you will remember the time during COVID when we withheld dividends, and that was the best decision we made. If you looked at the growth charts, if you looked at our asset base, it doubled at a time of such difficult economic times. And it was just based on the decisions that the board and management had made that this is not the right time. It is a right to conserve capital, to make sure that when COVID ends, we have the resources to take advantage of the opportunities that arose. So I just want to assure you that the board, both at the group level and at the subsidiaries, are on top of that. And what the management has promised you today in terms of their outlook for 2025, the boards take that very seriously. And we use it as their scorecard every quarter to ask them, you promised our investors and our customers this. You promise our customers that they will be able to have a system that is stable, they will be able to transact at all times. You promise them that you are going to be customer-centric. Show us how you have worked towards achieving that objective. We will ask, you promise our shareholders that you are going to cut down costs and you are going to increase revenue. Show us what steps are you taking. So I want to assure you that the group board sees all because we represent you as shareholders to oversight management and to hold management accountable for what they have promised. And I want to promise on the behalf of our boards that our boards are up to it. When you get time and when we publish our integrated report for 2024, I want you to take time and go through the profiles of not only our management, but also our board members across all subsidiaries, and you will get very surprised at the talent that we have been able to attract. I thank you for turning out today, and thank you for continued support of our organization, and the fact that you have all bought into our dream and our purpose. And we promise that we shall keep to that purpose. Thank you very much, and God bless you. Thank you.
Let's appreciate Chairman once again. Thank you. As we come to the end of the investor briefing, I want to request our Reverend to come and close for us with a word of prayer. Thank the Lord for the year that has been, and also position us for the year that will be, and then we'll do the equity anthem.
Thank you very much. Shall we pray? Almighty God, our Father and our God, in humility and thanksgiving, we come to you. Lord, we thank you for every victory, lessons, and the challenges that we are able to overcome last year. We want to pray for the investors, the shareholders, pray for all the customers, the employees, and even the partners who have journeyed with us this far. Heavenly Father, as we continue to champion the socio-economic transformation of Africa, as we empower consumers, businesses, and even communities, we pray for your divine guidance. We commit our plans for the year 2025, praying the Lord, you shall open doors of opportunities. I pray for divine favor, alignment, and success in the market. We commit our board before you. Pray for the senior executive members and management, praying for all leaders at all levels. The Lord, you shall give us the spirit of revelation, wisdom, and discernment to be able to make the right decisions. Give us clarity of vision and purpose. We pray, Father, for strength and health, that we may be able to lead and even to execute to the glory of your name. As we continue, Lord, we pray that you guide our steps, order our path, level every mountain, fill every valley, and remove every obstacle before us, O God. Grant us success in all our endeavors. Lord, just as you parted the Red Sea, our prayer this morning is that you shall part the seas of impossibilities in our lives and even in our plans. Heavenly Father, as we live, we pray that your peace will be upon all of us and that your presence will accompany us in all our decisions and in all our endeavors. Father, may your name be glorified. Blessed be your name. And we pray that, Lord, continue to watch over us. And as we live now, be with us. For this we pray in the name of the Father, Son, and the Holy Spirit.
We can be upstanding for the equity anthem.
Wafanyakazi na wateja wote, tuko pamoja, lengo letu moja, kuyaboresha maisha ya